Welcome everyone to Vested Interest. This is Shane back for a Stock Pick of the Day video. It is August 22nd, Thursday. This will be the last Stock Pick of the Day video for the week. I do these Monday through Thursday where we take a look at a company that's pulled back on the day to see if it is presenting any value. Today we will be looking at one that used to be in my portfolio. This one had a huge run up after I bought it. So I did sell it for a nice little profit. I only had a few shares. Really, I was running actually options on this on 100 shares. I wish I would have kept them whenever I first bought them. And then I really would have had a nice run up, a nice profit on that one. But I did not. I ran options until it went out of my cost basis. I had kept, I think, 2 or 4 shares there, and then it really ran up. So I went ahead and sold those for a little bit of a profit. But it has since really pulled back. So we're going to look at it again. Williams and Sonoma out of the consumer discretionary sector. Now, before we get too far into the video, if you could do me a huge favor, doing this really does help a small YouTube channel like mine with the YouTube algorithm. Make sure you hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Make sure you click that notification bell so you're notified whenever we put out any new content. Again, we do these Stock Pick of the Day videos Monday through Thursday, so you're going to get at least 4. If the market's open, you're going to get at least 4 videos a week, plus a 5th one on Sundays for our portfolio update. So I pump out at least 5 videos a week, so make sure that notification bell is clicked so you can tune back into all of those. And a special thank you to all of the subscribers out there. The channel continues to grow because of people like you. We are over 1,000 subscribers now. Really do appreciate all the continued support. And for those of you out there, again, hit that subscribe button. Let's get to 5,000 subscribers. That's the next stop. And then to 10,000 and beyond. Really appreciate everyone's support and help getting there. Now, this is the Vested Interest Stock Screener. This is how I look at companies on a high level to see if I'm interested in adding them to my watch list. If they make it onto my watch list, I do more of a deep dive into their financials. So this is just an initial screener. Thousands of stocks out there in the stock market to choose from. This helps me whittle down to ones that I'm really interested in, and then again do more of a deep dive into those. So we're going to run through this video, run through the criteria here, see if it meets 5 of 8. If it was a bank or insurance company out of the financial sector, I like to throw in price to book, where we use 1 as fair value, anything under 1 undervalued, anything over 1 overvalued. You can use price to book for any company, but if it's not a bank or an insurance company, something like that of the financial sector, make sure you're comparing that company's price to book, whichever one you're looking at, to other companies in the same sector and in the same particular vein of business, right? So if it's let's say out of the industrial sector, Union Pacific, a railroad like that, you'd want to compare it to like Canadian Railways, another railroad, so in the same industry, in the same sector. All right, let's jump over back to Williams Sonoma, www.williams-sonoma.com. That is their homepage where I pulled this information from. That is www.williams-sonoma.com. Again, their homepage where I pulled this information from. And you can see here all the different brands under Williams and Sonoma. So there's Williams and Sonoma, obviously Williams and Sonoma Home, Pottery Barn for kids. Looks like this Pottery Barn Teens, West Elms, Mark and Graham, what is that? Revolution, Green Row. So there are all of the different brands that fall under Williams and Sonoma, and they offer products, you know, in cookware, cooks, tools, cutlery, electronics, bakeware, food, tabletops and bars, home essentials, outdoor and gardens, furniture, stuff for holidays, obviously gifts, you know, if you're buying something for someone else. And if you go to their homepage, you click on and see what they have for sale. Now you can see Charles E. Williams. Here's the founder, right? Here he is. Now, this is probably the most recent picture of him. But here he is way back in the day, 1953, first trip to Europe. So he did take a trip over to Europe. He saw what was going on with the cutlery and the kitchens over in Europe and France, Germany, and Sweden, liked what they were doing, thought it was a good idea to bring those products here to the United States so people, you know, could use them in their kitchens. So that's what he did. In 1956, the first Williams and Sonoma store opens. And then in 1958, Williams and Sonoma opens in San Francisco. That's one of their very first Williams and Sonoma stores there as well. And then the rest, as they say, is history. Obviously, they expanded out to more stores, eventually created their online source. Their products being sold by mail, I'm sure, was before that. So you probably maybe still do. I know every now and again I get a Williams and Sonoma catalog at my house. which we typically just throw in the garbage. But that was probably how they expanded initially through catalogs, and then obviously in the digital age we are in now, online as well. Again, out of the consumer discretionary sector. And you may have bought products from Williams and Sonoma over the years, especially if you ever visited a Pottery Barn and maybe you didn't even realize that they were Williams and Sonoma products. Now, the reason we are taking a look at them, huge drop on the day, down 9.29% on the day. That's a huge drop for a year, let alone just one day. Again, they have been pulling back. I think they got up to about 160 recently. 170, we'll see here in a second. But Williams and Sonoma, ticker WSM, again out of the consumer discretionary sector, closed out the day at $130.48. 52-week range as low as $69.02, as high as $174.26. So they are still leaning slightly towards their 52-week high. But if they continue to drop back, they will quickly reach closer to their 52-week low here. I think I was buying them in the $100 to $110 range, maybe even $120 range whenever I finally stopped buying them or running the options on them there. And then again, they just ran up. I believe they hit 150 whenever I sold, but then continued to run up to 160. I don't know that they got up to 174, but 52-week range, their high over the last year was 174.26. I don't think I quite sold at the top, but that's okay. Market cap of $16.782 billion. So they are a small cap company here, a beta of 1.74. So very volatile, more volatile than the overall market. And you might be able to use that volatility to your advantage. Again, with a lot of these companies that are volatile, they'll run up, but then they'll pull right back. You want to be buying whenever they're pulling back, not on the run up, right? Maybe on the run up to a point, but not, in the 170 range. If you were buying in the 170 range right now, you've really locked in where you're seeing a loss. Don't sell, right? It can get back up to that 170 range. Maybe even buy it as it comes down to decrease your cost basis if you're holding this one. PE of $16.03 per share. Now, I really like companies like this a little lower unless they have really fast growth. 15, 14, 13 would be a good PE for a pretty well-established Williams and Sonoma company, though this one might be growing fast enough to justify a PE 16, 17, 18 possibly. I'd need to really look at how their growth is forecasted. We'll see some of that here, but again, this is just a high-level review. EPS $8.14 per share. That's nice. Earnings date was August 22nd, so that was today. So I'm assuming something in the earnings, either they missed top line or bottom line or both, or their projected forecast was revised down or just low in general, right? So they must have missed something here. Want to check out that earnings report if you're interested and see what's going on. For dividend, $2.28. They are quarterly payers, divide by 4, though we will see that price per share per quarter here in a little bit, or the payout per share per quarter here in a little bit. Dividend yield is low on this one, 1.58. But again, if you use that volatility to your advantage and got this one, down in the low 100s or even under 100, if it drops that low, obviously your yield would be higher that you could lock in. I think I had about a 2.2 dividend yield on this one whenever I had it. So obviously you can definitely get that if it continues to drop. Ex-dividend date, July 19th. Looks like they paid out, or they are going to pay out, on the 23rd. So it looks like they're going to pay out tomorrow. So if you owned them before the ex-dividend date on July 19th or July 18th or sooner, then you will get your dividends tomorrow. 1-year target estimate, at least according to Yahoo Finance, $149.58. So they do see some upside from where it currently sits over the next calendar year as far as price appreciation goes. Now we're going to jump over here to the right. We're going to look at their 5-year dividend yield average compared to its current. We're taking a look at dividend yield theory here and see if this one is potentially undervalued. Again, 5-year dividend yield average, 2.08. We compare that to the current 1.58. And since the current dividend yield is lower than their 5-year dividend average, that actually speaks to overvaluation on this one. So again, my dividend yield, I believe, was 2.2, 2.3%. And that's where I'd want to be, above 2% at least on this one. For me to be interested again. So it's got some further pullback to do. I'd love it back here at the 52-week low. I'd probably just, I might even sell a couple other positions to buy into this one if it dropped that low again. Payout ratio is very low, 23.54%. That's another thing that I like about this one. Very low payout ratio, and we'll see here in a little bit, they have been raising that dividend very aggressively. We're going to jump down and look at free cash flow. I like growing free cash flow over time because typically if a company has growing free cash flow, their dividends are safe. They increase dividends over time. They're able to pay down debt. They're able to make acquisitions. It keeps the company financially sound. and they're able to pay down debt and pay dividends to you as a dividend growth investor. 2021 here, you can see 1.1 billion in free cash flow. 2022 up to 1.14 here, a little bit of a jump up. 2023 there was a drop down so far. Excuse me. In 2024 here, looks like they're at 1.49. So they just reported in January their numbers at 1.49. So it looks like there's a jump back up from 2023 to 2024. So overall, it is higher free cash flow in 2024 than it was in 2021, but there was that drop from 2022 to 2023. Now you can see here repurchase of capital shares. They have been aggressively repurchasing their shares. 150 million in 2021, 2022 899 million, 2023 880 million. And even though there was a drop in free cash flow there was also a drop in the repurchase of shares. That's why I'm saying there definitely was a drop there in 2023, right? So that was a drop in free cash flow. They did maintain almost their repurchase of capital shares, but it is a drop overall. The repurchase of shares does not account for that. Sometimes it does. It did not in this case. And 2024, it looks like they backed off a little bit on the repurchase of shares. Maybe they felt it was overvalued. They're at 313 million so far. Now we're going to jump over to stockanalysis.com. The previous page was Yahoo Finance. I always recommend more than one source of for you to look at for information. So just make sure you're not blindly trusting one source. So you can make sure the information you're getting is accurate and up to date. Now they have 18 analysts that have taken a look at this. They call it a consensus hold. They have a low estimate of $72. That would be a 46.04% decrease from where it currently sits. Average estimate of $137.03. That would be a little bit lower than what Yahoo Finance had it on the previous page and not much higher than where it currently sits, only a 2.7% increase. And if it happened to hit their high of $175, that would be a 31.15%. All the while, you could lock in, if you were to buy them now, that 1.5% dividend yield. We're going to jump over to statistics, see how well this company is reinvesting its capital back into itself. To do that, we look at return on equity and return on invested capital. I like 10% or better for these numbers. Return on equity, 55.96%, smoking high. Return on invested capital, 26.64%. Again, almost 3 times what I'm looking for. Very, very good numbers overall. EPS growth, I typically like 5% or better. Oh, 25.78%. Beautiful, beautiful. 5 times higher than what I'm looking for. Really, really like that. Revenue growth forecasted over the next 5 years at 3.44%. Good numbers overall on this one so far, except for this price per share. Now they are a quarterly payer, as we said. Dividend payout ratio low, 27.96%. I think it should 25 on Yahoo Finance. Again, that's why I like more than one source for information. We'll say around 26% for payout ratio. Dividend growth at 21.13%. Now I'm not saying they're going to maintain this, over the next 10, 20 years, but even if they maintained it for the next 5 to 10, even 3 to 5, that's smoking high dividend growth, and their payout ratio is low enough that they can continue to grow it. Again, maybe not at 20%, but definitely in the double digits. Even if they dropped down to 10%, 12%, that's smoking high dividend growth. Growth year is 18, buyback yield at 2.22%. So when they are buying back shares, they're doing it at the right time. Shareholder yield at 3.81%. Let's go through their history real quick. They do pay out on the February, May, August, November timeframe. I like that. That's part of the reason I picked them up. I was looking for some companies in the February, May, August, November timeframe to kind of even out my dividend payout. Still part of the reason why I'm interested in them. Not only that, but their numbers look really good. Going back January 2022, here you can see they were paying 35 cents and some fractions of a penny. April 2022, they raised it up to 39 cents. April 2023, they raised it up to 45 cents. April 2024, up to 56 cents and some fractions of a penny. Most recent raise was actually July 2024, up to 57 cents. So they are aggressively raising their dividend, and I would anticipate probably not another raise in 2024, but another one in 2025 to maintain that nice smoking high dividend growth there. Let's jump back to the screener, see how this one stacks up, understand the business. That's where we started. Check there, growing free cash flow. We had the one downturn in 2023. Growing dividend, it is growing. Dividend pay extremely fast, over 20%. Again, I don't know that they'll maintain that, but double digits would be nice. Dividend payout ratio, 75% or less. Yes, under 30%. Like that. Check valuation. Dividend yield theory actually says it's potentially overvalued. No check there. It is not within 15% of a 52-week low. No longer in my cost basis, or no longer in my portfolio, so not below my cost basis. Return on invested capital, so no check there. Return on invested capital, return on equity, over 10%, smoking high, check there. Earnings per share growth again, over 5%, smoking high. 1, 2, 3, 4, 5. It is on my watch list. It is one I'm watching for the right price. I would love to add this back into my portfolio for the right price. I'm really looking for something around 110. I wouldn't mind jumping back into this one around 110 or under. I'd love it, again, under 100. Back closer to that $69, $70 range that it dropped into the 52-week low. But I was buying this at 110 last year whenever I added it, running a wheel on it, and I wouldn't mind doing so again. Well, that is really it for this one. Let me know what you think of Williams and Sonoma. Is it in your portfolio? Is it one you're watching? Did you recently sell it? Again, it really ran up, 160s, if not the 170s. And it I wouldn't have been mad at you if you locked in significant gains. If you were buying it in the low 100s and ran it up to 170 and sold it and locked in gains, hey, kudos to you. But let me know what you think. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Williams and Sonoma you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below. I'll try to work it into the rotation over the next couple weeks. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion, and investing during educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.